There is so much in the news these days that it can almost be overwhelming. And obviously, I do not have the time to report in depth on absolutely everything. So periodically, I'm going to pick up a paper and I'm going to tell you what I'm looking at and explain to you what that means. Coming up. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service gold and silver dealer specializing in custom strategies to help you survive and thrive the reset that has already begun. Well, what I'm going to be doing is I'm going to be looking at the paper, and I mean, anybody could do this. Do you understand really what you're looking at? Like, for example, now this is going to require deeper, so in some cases, like yesterday, this is from today's paper, today's Wall Street Journal. Fed steps in to curb soaring short-term borrowing costs. Okay, I want you to listen to this. This one I am going to do in more depth next week. But for the first time in more than a decade, the Federal Reserve injected cash into money markets Tuesday. Do you remember in 2008 when there was a run on the money markets and they shut your ability to liquidate down? And then they went in and they changed all the rules, putting in fees and gates, in other words, tools to stop you from wanting to liquidate. Now, this is the repo market that we're talking about here. The pressures relate to shortages of funds banks face, resulting from an increase in federal borrowing and the central bank's decision to shrink the size of its security holdings in recent years, right? They were trying to wind down their balance sheet. Nah. So we're going to be talking a lot more about that next week. But the fact that this has not been done since the crisis, and the fact that they go on TV, and I mean, even here, I love this, resilient growth bolsters stock rally. The reality is that people think they have no other choices but Wall Street choices, stocks and bonds and all of these ETFs and mutual fund and all of these products. That is not true. You have choices that are outside of their system. So what's happening is as the trade wars go back and forth and, China's going to remove tariffs on soybeans. That's awesome. Does that really make a difference? The answer would be no. The damage has already been done. The debt damage, that debt bubble has already begun to pop, and we are in really deep trouble. But I looked at this one too, and I think this is absolutely fascinating. And that is, more banks switch to federal oversight. Well, do you remember? We did something on this a while ago. The Office of the Comptroller of the Currency, the OCC. And remember, on a quarterly basis, they update derivatives, so those big derivative bets that are held inside of the FDIC insured deposits. So listen to this. And by the way, there's two articles that we need to be aware of on this page alone. The OCC head, Joseph Otting, a Trump appointee who calls banks customers. We're not the customers, even though he's head of a federal agency that is supposed to oversee this. We're not his customers. It is the banks that are his customers, has praised national charters as a way to let banks operate more efficiently and be regulated more thoroughly. From 2014 to 2016, no state banks converted to OCC oversight, according to the FDIC. But more than 100 billion, so since 2017, a couple years ago, more than 100 billion in bank assets went from state to federal oversight through conversions in 2018. So that's just 1 year, compared to 8.6 billion going from federal to state oversight. So this is the difference. The big banks are removing themselves from state oversight and going into the OCC oversight because the rules are more lenient, because of course the OCC is catering to their clients, the banks. It's clear that we've gone back to the days when the OCC was the cheerleader for the national banking industry and an aggressive champion for every kind of deregulation, said Arthur Wilmarth, a law professor at George Washington University. Okay, the very next column, so this is all from this week, by the way, and these happen to all be Wall Street journals. But agencies move. This is a different article, but at least it's next door. Usually they're pages apart. Agencies move to ease rules on swaps. Washington banking agencies moved to ease a post-crisis rule that could free up nearly 40 billion for big global banks, the latest regulation victory for Wall Street. We've been talking about the deregulation, but now we have investment banks and that take risk commingled with deposit banks that take your deposits. Think Merrill and Bank of America, but a lot of them are set up this way. The FDIC said the office of the OCC approved a proposal to reduce the cash large lenders, including JP Morgan Chase, Goldman Sachs, must post to cover the risk of trades going bad in the swap market. The swaps are contracts in which two parties agree to exchange payments based on fluctuations in interest rates. Think about what's been happening with the interest rates over the last couple of days. They have been wildly swinging because this market is falling apart. So here you have all of these banks switching to lighter oversight and lighter regulation. Yeah, I'm sure everything is just hunky-dory. So the FDIC, led by Jelena Williams, voted 3-1 to advance a proposal eliminating the requirements. I will be doing something more on both of this, but particularly the swaps. I've had it on my agenda for a while, and it's really rising to the top. Well, there's a lot more that I could go through. Here, I'll do it really quickly. Banks revive mortgage bond business. This is what crashed the system in 2008. It basically died. You can see the red going into nothing, and they're reviving it. That's awesome. Citi, Goldman, Wells Fargo. What can I tell you? I go through these and I just shake my head. But we've got a lot more to talk about. Gold and silver manipulation next week, and I'm going to do a whole big piece on that. It's not just JP Morgan. There are a lot of banks that are involved in this, and I'm going all the way back. Wait until you see this. I already pulled the data on it, and I'm also going to talk about the repo market, which I touched just briefly here. Again, hasn't been done since the crisis, but that really requires an in-depth thing. So come and join us for both of those next week. We also have this week, the SGT interview should be released. A Coffee with Lynette with Ron Paul, which was awesome. I mean, awesome. What a man. I mean, he's just so impressive. And that will be also released next week. And I have Coffee with Lynette with Gerald Celente, who you know is one of my very favorites. I just love him. He's just great. And also next week, you'll hear me on X22. So that's it for today. I will see you tomorrow. And in the meantime, keep in mind that financial shields are made of metal. So until tomorrow, please be safe out there. Bye-bye.